So let's have a look at our national income. Right, the first thing we're going to look at, and I'm just wanting the whole thing to load quickly because it's a very, time is what is not on our side for today. So here we have the circular flow. This is not new to you. You've dealt with this diagram in grade 10. And there we have our participants, the households, the business, the state or government, as well as the foreign sector. So with that, you should know that this is what you're looking at is an open economy. And then we have our markets within the circular flow, which is the product market, the factor market, your foreign market, and your financial sector, your financial market as well. And as you know, your households sell their factors of production via the factor market to the businesses. And these factors of production are entrepreneurship, land, labor, and capital. And then the business uses these factors of production in order to produce the goods and services which they sell via the product market to the households again. So what we're looking at there is what we call our real flow, right? And then for this, the businesses will pay the households their rent, profit, interest, or wages, which is the remuneration for the factors of production, and they will pay that to the households, which is then an income for the households. That income the households will use to spend on the goods and services which is provided by the businesses, thereby generating income for the businesses. And as both of these factors, both of these participants are earning an income, one of the things they have to do is to pay taxes to the state. And then that is also known as what we call a leakage, right? So that is what that T is all about there, right? Your leakages is equal to S plus T plus M. So the T there is for the taxes, which they pay to the state. And then in return, the state will provide both the businesses and the households with public goods and services. And that in turn is an injection, which is represented by the letter J, which is equal to I plus G plus X. And here the G is for government spending, right? And then you also have, your foreign sector. So what happens is the exports that businesses sell to them causes money to flow into the circular flow. So therefore, your exports, which is represented by the X, is an injection, and the M with the L, which is the leakages, will be for imports. Because remember, in order to receive that imports, we have to spend money in order to get that. Right, so as you can see, that represents the money flow. So that shows you how money is flowing. And then, of course, the households and businesses would save money with the financial sectors, which they therefore leaving the flow. Therefore, savings is also seen as a leakage, but it is that savings which your banks and your financial institutions will use to give out as loans to businesses or households to invest in whatever projects they want to undertake, and therefore investment is your injection again. So if you see, your savings is what creates investment, your taxes is what gives rise to government spending. That's the income that the governments earn that they can spend. And then obviously your imports and your exports are opposites. So that is just to explain that diagram to you. So based off this, obviously, you can see all the money flowing here. So that creates the income within the economy. Right. So when we are looking at our national accounts, So we're going to look at national account grand totals and conversions from domestic grand totals to national grand totals. So our national account aggregates, there are 3 ways in which this can be calculated. And the first one that we're going to look at is the basic price, which is our gross domestic product production method. The P stands for production method. And within this method, we look at the various sectors. So we look at the contribution made by each of the sectors within the economy. So this is your basic price. So this is your primary sector plus your secondary sector plus your tertiary sector. But then we move on to the next method of calculating, which is your gross domestic product using the income method, and that's what the I is for there. And here we work off the factor cost. So what we mean by factor cost is the cost of the factors of production. So your factors of production, this is your compensation paid to employees, your net surplus, as well as your consumption of fixed capital. And then the third method that we use is called the expenditure method, and here you're looking at your market price now. So this is what you were taught in grade 10. You were taught the C plus G plus I plus X minus M. So C, G, I, and then there's a residual item, and then the X and M has been left off here somehow. When the copied over, it sort of disappeared. Right, so the compilation of national accounts grand totals takes place according to internationally accepted standards. So what that means is that we don't just have, it's not just in South Africa that we are employing these 3 methods of GDP calculations. It is something that is used globally. So it doesn't matter where you go in the world, you will see that governments use the production method, the income method, and the expenditure method. And what I always say to learners, because one of the famous questions they like to ask is, name 1 or 2 of the methods of calculating GDP. And then students get all confused. The best way to remember this, it is a P, you've got I, and you've got E. So if you look at P-I-E, that spells the word pie, something all of us love, right? So pie is what you remember to remember the methods. P for production, I for income, and E for expenditure. Right, so when you're working with your national account aggregates, there are some concepts you need to know. Because as you know, these concepts are what gets tested in your section A. So for your multiple choice at 1.1, you need to know your concepts. For 1.2, where you've got to match the column, if you know the concept, you'll be able to make the correct connections with the description and the concept that is tested. And then 1.3, where they give you a statement and you've got to now recognize the concept. So it is important that you learn your concepts with each section that you do. So with this, I've now listed 10 concepts that's important. So the very first one here, factor cost, they will ask what is meant by the term factor cost, and that simply means it is the cost of employing the factors of production. So please remember that your factor cost deals with the cost of employing your factors of production. And when we look at the various methods, I will come back to this again, right? And then basic price, that simply is your cost of production, right? What it costs to produce the product. So that's the basic price. And obviously your market price would be the price which is paid by the consumer, in layman's terms, meaning the selling price. And then, of course, there are taxes involved as well. And taxes, they are a compulsory payment for all residents, right? Now, please, we use the term residents because, as you know, we also have foreigners who live in South Africa. They're not South African citizens yet, but they have a residency. Or we have South Africans living outside of the country. They're not citizens of that new country, but they become residents first. So taxes are paid by all residents. And then the different kinds of taxes that we have, there is direct tax, which is taxes on income, and there's indirect tax, which is tax on expenditure. So when you think about income tax, as personal individuals, we have to pay tax on our income, and that is the PAYE system, the pay-as-you-earn system. And of course, companies are seen as individuals, so they also pay tax. So the two direct taxes that we deal with is company tax and the pay-as-you-earn. Whereas your indirect tax, on the other hand, deals with tax on expenditure. Right. Then specifically to the national account aggregates, you're going to deal with things such as tax on products and tax on production. Very popular question. Discuss the difference between the two and examples of them. So your tax on product, this is tax that is charged for a product or service, right? But the important thing is here, this is on a finished product. So the tax, there's an example of a tax on products would be VAT. There are other examples such as import duties, excise tax, etc. And then there's also tax on production. Now the difference between this, the products is the final product that's already been produced, whereas tax on production is not linked to a particular good or service. And an example here would be a business license. Then, besides the taxes, we also have our subsidies, and you've got your subsidy on products as well as your subsidy on production, right? So first of all, let's look at what is a subsidy. A subsidy is financial assistance from government to sell at a lower price to the consumer. So the idea behind a subsidy is so that it is cheaper for the consumer and the consumer has access to the product. So a subsidy on products is subsidy on specific goods, for example, bread, and then your subsidies on production. This is not linked to a specific product. And then very important to watch out for in national accounts aggregates is the idea behind double counting. So double counting exists where a transaction is counted more than once. Therefore, when we work with national account aggregates, we work on final goods and services, because remember, while the good is in process, while it's still being made, we can't count that in, because what will happen is, so we're counting it whilst the product is still being made, and then at the end we count it again. That is what constitutes double counting. So therefore, we only look at the finished goods and services, or the final product. Okay. Then we're moving on. We're looking at the first method, which is our production method, denoted by GDP and a letter P in brackets. So this calculation method is based on addition of value added at each stage in the production process, right? Remember, we said this deals with the basic price, which is your cost of production. So here you're looking at your primary sector, which is made up of your agriculture, mining, forestry, and fishing industries. They all form part of your primary sector. So you look at the primary sector, then we add the secondary sector, and the industries we find within the secondary sector are things such as manufacturing, construction, electricity, gas, water. And then also the tertiary sector, which is made up of our retailers, insurance, property, etc. Right? So all our services forms part of the tertiary sector. Things such as education, health, all of those things would be part of the tertiary sector. And then these three totals added together will give us our GDP at basic price. And this is your price before taxes such as VAT, import tax, and also before subsidies on products are calculated. Right, so you take your GDP at basic price plus your taxes on products minus the subsidies on products, which will then give us our GDP at market price, right? And your taxes on products, here your GDP at basic price includes taxes on production and subsidies on production. That's already included there, right? And then here we now get to our GDP at market price. So a very popular question to convert GDP at market price to GDP at basic price. So what you're doing is you're converting your GDP at market price to GDP at basic prices, right? So you start with your GDP at market price plus your subsidies minus taxes. Remember, I just said now when we were working down here, I said it is GDP at basic price plus taxes minus subsidies equals GDP at market price. But now we're working backwards because we're converting the bottom one now to the GDP at basic price. So by working backwards, this is where your maths that you do in grade 9 comes into play here. So because we're working backwards, it is GDP at market price. So the minus now becomes a plus, and that plus then becomes a minus to give us our GDP at basic price, right? And then to convert GDP to GNP, so remember you've got to know the difference between GDP and GNP. Is there anybody out there that can tell me or that knows what the GDP and GNP differences are? I'm waiting to see if there's anything coming through on the WhatsApp. Right. Your GDP refers to all the final goods and services produced within the borders of a country. And that doesn't matter if it's produced by foreigners or by residents of the country. Anything that is produced within the borders of the country, that forms part of your GDP. Whereas your GNP, on the other hand, there you're only looking at what is being produced by the residents of the country. So therefore, you need to remove the foreigners that is in the country. So you've got to take that GDP that you've calculated, remove the foreigners, and you've now got to add your residents that are working outside of the country. So your South Africans working in other countries, their income has to be added, and those foreigners working in South Africa, their income must now be taken away. So therefore, to convert GDP to GNP, it is plus primary income from the rest of the world. So those are your South Africans working outside, less primary income to the rest of the world, which refers to your foreigners working inside the country. Now let's see how all of this works. Right, that brings us to our first exercise. Exercise 1. Study the information below and answer the questions that follow. So they give you your GDP according to economic activity, and your numbers here are being expressed in rand million. That's what it means, right? So for exercise 1, there they've given us primary sector, secondary sector, tertiary sector, taxes on products and subsidies on products. And the first question asked here is, which method is used to calculate GDP? So how do we recognize the method that is being used? We look at the information that is given. So they're talking about the various sectors of the economy, and if I remember correctly, from what we've just gone through, which method was that? That was the very first method we looked at, which was GDPP, which in other words, that means that is known as your production method. Okay, so there, that will be the that would be the production method that we are talking about there. Number 2, the question here asks, I'm going to give you 1 minute or 2 minutes to just calculate for me the GDP at basic price. And please do not forget, use your notes if you're not sure, okay? go back to the notes and check how do you calculate GDP at basic price. I'm going to give you 2 minutes to just quickly do that. Okay, right, I hope you've all managed to get the answer. I'm first going to give you the answer and then we're going to see how we derived that answer. So the answer will be 3314978. 3314978. So how did I get to that answer? It was the primary sector, which is 246380, plus the secondary sector of 317965, and then lastly the plus the 2750633. So it's those three totals added together, which then gave me the 3314978. And if you just wrote down these answers as follows. Right, if you just wrote your answer as 3314978, then I'm afraid you will not get the full mark because you've got to still put in there that it is in rand million. So there must be a you don't have to put it for every number that you're adding, but your final answer, you must have the rand in the front and the M at the back to show that your final answer is in rand million. Right, question number 3 says, calculate GDP at market price and show all calculations once again. So, and that is for 4 marks now, right? So that one was for 3 marks, and the way that you would get those 3 marks is obviously your 2 marks for your final answer and 1 mark for having these 3 totals adding correctly. Right, and here now again, calculate GDP at market price. So you should know to get to market price, what do I have to do? I have to start with the basic price. So I've got to use my answer that I got here, which is the 3314978. And to get from GDP at basic price to GDP at market price, I have to add taxes on products minus subsidies on products. So therefore, to show all calculations, I've got to then have there 3314978 plus 309486 minus 17558, and that will then give me a final answer of 3606876. Now can you see here, I've got my rand signs and I've got my rand signs, but I forgot to put my M at the back. So you see, even we make mistakes, eh? So I forgot to put that M at the back there. So therefore, that would not be marked correct. Okay, there will be a -1 for not having the M there. But the way in which your 4 marks will be allocated, they could give you 1, 2, 3, 4. 1 mark for each total. Okay, that's one way in which it could be allocated. Right, so for the GDP according to the production method, we're looking at the economic sectors. And to get to GDP at basic price, we simply add the 3 sectors. And then when we convert basic price to market price, we add our taxes on products and minus our subsidies on products. That's sort of a summary for your production method. We're moving on to the next method now, which is our income method, denoted by GDP and in brackets I. The calculation method is based on income within the land borders earned by the factors of production. So here we're looking at the factor cost once again. So we're looking at compensation paid to employees, which simply means salaries and wages. Net surplus, which is your net profit after tax. Consumption of fixed capital, which means depreciation. Now the word consumption means to, if you think of the word to consume something, it means you're using something. So here we're looking at the usage of our fixed assets. And an example of your fixed assets would be something like machinery. But as more we use it, the value of that machine is deteriorating over time. And that is what is called depreciation, right? Depreciation is none other than the decreasing in the value of the machine or the vehicle, right? When you buy a vehicle, you can buy a brand new vehicle. The moment you drive it off that showroom floor, you've already lost 10,000 Rand of the value of the vehicle, right? So as you use the machinery and the vehicles, the value is getting less and less, and that is called depreciation. So that is what consumption of fixed capital is all about. So we add those 3, the compensation paid to employees, the net surplus, and the consumption of fixed capital. And those then gives us our GDP at factor cost, okay? And factor cost is what is linked to the income method. Then that factor cost, we add taxes on production, right? And we subtract subsidies on production. What you need to understand, if you talk about taxes on production, these are taxes such as, like we said, site, pay as you earn, payroll taxes that you have. Subsidies on production refers to employment subsidies. So to get from factor cost to basic price, you add taxes on production minus subsidies on production, and that gives us our GDP at basic price. And then it's exactly the same as it was with production method. To convert basic price to market price, you add taxes on products and you minus your subsidies on products to give you your GDP at basic price, at market price. So if you see this bottom section here is exactly the same as your production method. It is only this top section here that has changed, right? Under the production method, you don't have factor cost, right? And you don't have your taxes on production and subsidies on production, right? They are already included in each of the sectors that we did previously, right? So how the income method differs from your production method, your income method has GDP at factor cost added in, and then to convert the factor cost to basic price, it is you still adding, you see it's always plus taxes minus subsidies. Here, plus taxes minus subsidies, but it is taxes on production first and subsidies on production before you come to taxes, because I find students sometimes get confused between the two. And the best way to remember this is that in order to get to the final product, it first has to go through the production process. So therefore, it is first taxes on production and subsidies on production, and then at the bottom, it is taxes on products and subsidies on products, okay? The other way in which to remember it is if you constantly remind yourself to convert GDP at basic price to GDP at market price, I add taxes on products and I minus subsidies on products. So therefore, GDP at basic price plus taxes on products minus subsidies on products gives me my GDP at market price. But with the income method, I'm starting with the factor cost first. So I've got to now convert the factor cost to a basic price. And in order to do that, it is plus taxes on production minus your subsidies on production, right? So remember, you first go through the manufacturing process and then you get to the final goods and services. Right, so we're going to move on to another exercise here. Exercise 2, there they've given us the information. Once again, rand million, and there they've given us compensation of employees, net surplus, consumption of fixed capital, and then they've got letter A and B, other taxes on production, other subsidies on production, and then you've got your letter C and D, and then you have taxes on products, subsidies on products, GDP at market price, and a letter E, and then primary income from the rest of the world and primary income to the rest of the world. So this is the information that's been given, and now we're going to have a look at the questions that they've asked. Right, so question number 1 asks, define the concept of gross domestic income, right? They're asking you to define gross domestic income. And then the learners say to you, but nowhere here, it's only at the top there they talk about gross domestic income, but we've never heard this term before, okay? It is not a new term. You've heard it, but as something else. Another way to describe gross domestic income is simply to call it GDP, which is your gross domestic product. So in other words, what this question is asking you here is to define gross domestic product. Same thing, right? And as I said to you earlier, your gross domestic product refers to, so in this case, you will now say gross domestic income refers to the total income received by all sectors in an economy or by all persons in an economy, right? Or in a country, right? Actually, in a country. Number 2, which entries are represented by the letters A and C? So let's go back. So there we've got A and there we've got C. So they want to know the entries. Another way in which they can ask you is complete the labels for A and C. So if I add these 3 together, these 3 added together gives me my GDP at factor cost. So therefore the letter A will represent GDP at factor cost. And then to convert my factor cost, then letter C will be GDP at basic price, right? So your letter A, the answer there would be GDP at factor cost, because there I'm adding up the cost what it's costing me to employ the factors of production. So that gives me GDP at factor cost. And then I'm adding taxes on production minus subsidies on production. So that's going to give me my GDP at basic price. Right, the next question. Right, they ask you describe the following concepts: compensation of employees, net surplus, and consumption of fixed capital. So basically they're asking you how would you describe this? So the compensation of employees, I said to you earlier on, this is the same like salaries and wages. So that is the money which is earned by the factor of production, labor. Your net surplus represents your profit after tax. So that would be the income for the factor of production, entrepreneurship. And then your consumption of fixed capital, that is also known as depreciation, because here you're looking at the value of the fixed capital being reduced the more you use the fixed capital. Right. Differentiate between taxes on products and other taxes on production, and then it goes further to say provide an example for each one. So the way in which you will answer this, you will first describe what are taxes on products, give an example, and then you will describe what are taxes on production, and then you will also give an example there. So very quickly, your taxes on products, these are taxes which you pay, like I said, on your final goods and services. And the example there, all of us are consumers. We go into the stores and we go and buy goods. And all of us, on any purchase that we make, we have to pay that. So that is an example of a tax on products. Whereas your taxes on production, on the other hand, these are taxes that are incurred as a result of production. And the example there would be your payroll taxes, right? The next question, differentiate between subsidies on products and subsidies on production. They don't ask for examples here. So I simply just have to give the difference between subsidies on products and subsidies on production, right? So your subsidies on products, once again, these are direct subsidies payable per unit exported, whereas your subsidies on production, these are employment subsidies and subsidies which are paid to prevent pollution. Right. Then the question 6 asks, calculate the values of the letters B, D, E and show all your calculations. So if you remember, it doesn't tell you here what you're adding and what you're subtracting, but that's all you're doing along here. Some of these you're adding, some of them you are subtracting. I'm going to give you 2 minutes to just work out B, D, and E very quickly. 2 minutes to just do that calculation. One more minute. Right. So to get the answer for B, I have to add all 3 of these numbers. And if you added all 3 of these, your answer for B should have been 3242437. 3242437. And then you go, so it's that answer that you got by B. Taxes are always added, subsidies are always subtracted. So then I go 3242437 42437 plus 86923 minus 14382. So the answer for D would then be 3314978. And then that answer that I get there would then be again plus taxes on products minus subsidies on products. So it would be so that answer for D would be 3314978. And then to get to E, you will now have to take that 3314978 plus 309486 minus 17558, which will then give you the answer for E, which is 3295756. And then question 7, they ask you calculate gross national income and show all calculations. So for number 7, you will now take that answer that you got by E, which was 3295756, and you will add your primary income from the rest of the world, and you will subtract your primary income to the rest of the world to then get your final answer for that one there. Right, we're moving on to the next one now, which is our third and final method, which is our GDPE, also known as the expenditure method. Right, so when we look at our GDPE, this is calculated by the total expenditure on all final goods and services within the national borders. So we're looking now from an expenditure perspective. So we're looking at how much money is being spent by consumers, how much money is being spent by businesses, which is your investment spending, how much money government is spending, and then we get a residual item. And here explains to you it's a balancing figure. I will explain to you shortly what that means. So you got all your participants in the economy spending, and you will add the residual item, which sometimes can also be a negative total. And that will give you your GDE, and GDE stands for gross domestic expenditure, right? The words GDE, gross domestic expenditure. And to that, we add our exports and minus our imports, which will give us our GDP at market price. Right, so what I want you to see now, with the other two methods, we had first GDP at basic price, then we had GDP at market price. With this method, we see we only have a GDP at market price. There is no GDP at basic price. The reason being, for the other two methods, you looked at from the production perspective. In the expenditure method, you're looking from a spending perspective. Now, as you know, there is no guarantee that you will sell everything that you have produced. So therefore, it does happen that sometimes there's some stuff left over. We haven't sold everything that was produced. And therefore, we have this residual item as the balancing figure. Because at the end of the day, this GDP at market price here must be exactly the same as the GDP at market price for the income method, must be exactly the same as the GDP at market price for the production method. So therefore, we have the residual item acting as a balancing figure. So therefore, I say to you, 9 times out of 10, yes, we would like that figure to be negative because it means that we'd like it to be positive because it means we haven't sold everything that was produced within the country. But if that figure is negative, then it means we've sold more than what has been produced, and that's impossible. If I produce 10,000 units, I cannot sell 11,000 units unless some of the stuff had come in some other way, right? That they've come into the country without being recorded somewhere or without any knowledge of anybody about the goods being within the borders of the country. So therefore, we would like that residual item to be a positive figure, but it can at times be negative as well. Right. So let's have a look at the total here, what they're saying here. So here they give you a table and there's all the amounts. These amounts have also somehow jumped. The gross capital formation is 620,531 and the residual item is 38288 and there. So now the question is, which method has been used to calculate GDP? And obviously it is the expenditure method. Define the term residual item. I just told you now that the residual item is a balancing figure, and the reason we have it as a balancing figure is so that the GDP at market price according to the expenditure method is equal to the GDP at market price according to the other two methods. 3.3, provide the correct symbols for the following. So, final consumption expenditure by households. Households, when you were in grade 10, we taught you that the households are represented by the letter C. Final consumption expenditure by government. Government is represented by the letter G. Gross capital formation, which is your investment, so that would be the letter I. And spending by foreigners on South African goods. That means outsiders spending money on our goods. So therefore, spending by foreigners on South African goods would be exports, which is represented by the letter X. And spending by South Africans on foreign goods would be your imports, which is represented by the letter M. 3.4 asks, provide synonyms for the following. Gross capital formation, it's represented by the letter I, so obviously that is investment. Spending by foreigners on South African goods, we just said there, that is represented by letter X, so that would be exports. And spending by South Africans on foreign goods, same as that there, we just said that's the letter M, so the synonym there would be imports. Right. And then that brings us to the final exercise in this session, which is exercise 4. They say refer to the table below and answer the questions that follow. Now this is a typical exam type question where you are given the table and now you are asked questions based on that. Okay? Obviously not these kinds of questions, different kinds of questions that can be asked. Okay, so I am going to give you a quick 3 minutes to just look at the formulae. That's all I want you to do, not calculations, just the formulae. So make it 2 minutes. Write down the formulae for A, B, and C. Okay, let's look at the first one. It says GNI at market price to GDP at market price. So to go from GNI at market price to GDP at market price. So therefore you're starting from the bottom and you're working your way up. Okay, so you will start with GNI at market price. So you will start with that, GNI at market price, plus your income to the rest of the world minus your income from the rest of the world, because normally you would add income from the rest of the world, right? So now you're going to minus income from the rest of the world plus the income to the rest of the world. So you've got to actually write that out. GNI at market price plus income to the rest of the world minus income from the rest of the world will give you your GDP at market prices. Then to go from GDP at market price to GDP at basic price. Now normally we work the other way around, so we're working back once again. So you start with your GDP at basic price, at market price, and you're going to add your subsidies on products minus your taxes on products to give you your GDP at basic price. And then to go from basic price to factor cost, you're going to start off with your GDP at basic price plus subsidies on production minus taxes on production, which will then give you your GDP at factor cost. And then 4.2, they're asking us now to do the calculations for each of these. Calculate GDP at market price. So to get to GDP at market price, so calculate your GDP at market price, they say there. And there's no calculation because there they've given it you right on top there. They've given you GDP at market price. Okay? So this should have actually said GDP at market price is given to you there. Sorry, GNI. So to get to GDP at market price, you've now got to start with this figure, which is the 3244304. So we're working our way back. So we're going to say 3244305 plus our income to the rest of the world minus our income from the rest of the world. So it is 3244304 plus 251374 minus 70942, which will then give you your 3424736. Now you must calculate GDP at basic price. So you've got to start with the GDP at market price, the answer you got there. You've got to now start with the 3424736 plus your 21765, which is your subsidies on products, minus your taxes on products, which is the 423813, which gives you your 3022688. And then to get to our GDP at factor cost now again, you start once again with your GDP at basic price plus your subsidies on products minus your tax on products. So that is, on production minus taxes on production. It is 8362 and your taxes on production is the 70541, which gives you the 2960509. And then they ask you to calculate A, and we know these three added together gives us our GDP at factor cost. So therefore, you now got your GDP at factor cost, which you've just calculated at C. So you start with that and you subtract the other two, and then your final answer would give you the answer for A. Please, grade 12s, do yourselves a favor, work through that workbook again and again. You don't need to do different exercises all the time. You can do the same exercise 10 times over instead of just doing 10 different exercises, because the calculations and the conversions are always going to be the same. So if you understand it this time, you will remember it all the time. Thank you very much. That's it for today. Good day.